Finzilla. Devour opportunities. Alright, look. You want to buy a house that's a good investment. Whether you plan to live in it, rent it out, or put it on Airbnb, the truth is that not all properties are created equal. You open Zillow on your phone only to find a sea of red dots with no way of knowing which ones will make you rich and which ones will make you poor. Welcome to the Golden Goose Strategy, or the 25-10-1 rule. This is how you narrow down your hundreds of options to the very best investment possible, otherwise known as your golden goose. Using this strategy instantly sets you apart from the masses and makes you an investor, not just another first-time homebuyer. This is how you build wealth in real estate and avoid being new house broke. How do I know? I've grown my own net worth from $20,000 to $550,000 in 2 years by repeating this exact strategy over and over. This is how you get paid while you sleep for the rest of your life, so you absolutely destroy normal. Just like you can destroy that like button and subscribe to this channel for more free content. So let's get into it. Today, we're looking in Amarillo, Texas. We've built our criteria ahead of time, so we know that we are looking for a 3-bed, 2-bath, built after 1970 for under $250,000, otherwise known as the old reliable of single-family investing. We come across this corner lot beauty with 3 recent price cuts over 3 months. This can either be a sign that something is wrong with the property, or we are stumbling into a motivated seller. Scrolling down, we see that the roof, kitchen, and bathrooms look to be in good condition, and the property is not part of an HOA. Given the state of the local market and the motivated seller, we are planning on putting in an offer 5% under asking price at $175,000. Right off the bat, we're seeing dollar signs, but let's do a quick calc before getting too excited. It all starts with the investment test card. Once you master these 4 formulas, you have deliberately given yourself an unfair advantage. Believe it or not, the majority of home buyers don't take the time to see whether the biggest purchase of their life will be a good investment. By watching this video, you are no longer in the majority. We are going to run our property through 4 tests: cash flow, cash-on-cash return, rent-to-value ratio, and capitalization rate. Not only am I going to show you how you can do this in less than 5 minutes, I will show you where to get every component of these equations immediately from Zillow so you can do everything using one app on your phone. Before we can plug and play into the test card, we have to get our net operating income, or NOI. This is your rental income after you have already paid all your expenses. This is the hardest part, but I've made it painfully simple for you by building a condensed expenses formula. All utilities will be put in the tenant's name, and we plan on managing the property ourselves. So for operating expenses, all we need to worry about are property expenses and landlord expenses. Property expenses are costs associated with owning a home, such as taxes and insurance. You would pay these even if you lived in the home yourself. Landlord expenses are costs associated with renting your home out to others, such as maintenance, vacancy, and cushion for unforeseen problems. First, I'm going to show you where our pre-built constants come from, and then we are going to condense everything into a short plug-and-play formula that you can use for any property at any time. Your property expenses are calculated from your property's fair market value. MortgageCalculator.com has the average tax rate in the US at 1.1% of property value, so that's what we'll use. Bankrate.com has the average insurance cost in the US at 0.6% of the property's value, but we'll use 1% to be safe. Landlord expenses are calculated separately because they are deducted from your gross rental income. The United States Census Bureau recorded an average rental property vacancy of 5.8% for 2022. The book Hold by Steve Chater states that maintenance and repairs are going to be 3 to 6% of your gross rental income. We use 6%. After applying 5% cushion, we have all of the components. Our condensed formula allows us to project annual property expenses by multiplying the property's fair market value by the constant of 0.021. Our landlord expenses can be projected by multiplying the annual gross rental income by 0.168. But you don't need to worry about any of that. We have done all of this work ahead of time, so all you have to do is plug your property's annual gross rental income and fair market value into this condensed formula, and you will get your NOI. Take your time and pause this video if you need to, or take a screenshot because everything is downhill from here. But hold on, where do we get the gross annual rental income? Scrolling down this property on Zillow, we see that it has a rental's estimate of $1,900 per month. Quickly comparing with other nearby rentals, we see that the rental's estimate is accurate. For even more certainty, you can use rentometer.com. Multiply by 12 months, and there you have it. Our gross annual rental income is $20,000. We already know the property's market value from the Zillow page. You can either go by listing price or the Zillow's estimate directly underneath to determine a quick fair market value. Plugging in our property's values and using the expense constants results in a net operating income of $15,087 per year, or $1,257 per month. All of that was the hard part. From here, everything else is easy. It's time to run this property through the 4 fundamental tests. Cash flow is king. For the cash flow investor, the goal is to be in the black, which means having money left over after all expenses are paid. With a purchase price of 5% under asking, a 20% down payment, and an estimated interest rate of 6.01%, our projected mortgage is $1,159 per month. We subtract our mortgage from our NOI and get a projected cash flow of $98 per month. Because we are in the black, the property has passed the cash flow test. Next, we look at year 1 cash-on-cash return. Cash-on-cash is one of the most important metrics for cash flow investing. How quickly you make your money back will determine how fast you can grow your portfolio of properties. With a projected year 1 cash flow of $1,176 and an initial investment in the form of a $35,000 down payment, we end up with a 3.4% cash-on-cash return. At this point, our corner lot beauty is starting to look like a dud. Investors typically shoot for a cash-on-cash return of 8% or better. With interest rates as high as they are in 2022, the cost of borrowing money is high, which has raised our mortgage and narrowed our margins. Keep in mind that our overall return on investment will be much higher when you factor in principal equity, appreciation, debt paydown, and tax depreciation. But we are only going to take the time to calculate our projected return if the property passes our quick test. There are too many good opportunities out there to put lipstick on a pig and settle for less. Our rent-to-value ratio is our monthly gross rental income divided by fair market value. When we plug in our property's data, we land at 1.03%. Investors consider anything under 1% to be subpar performance, so we pass the RTV test by a hair. Our final test is capitalization rate. Cap rate is an important metric because it demonstrates the profitability of an asset. With a previously determined annual net operating income of $15,087 per year, divided by the fair market value of the property, we get a cap rate of 8.2%. Single-family cash flow investors consider anything with a cap rate of 8% or more to be favorable, so once again, we are in the green. So how did the corner lot beauty do overall? It passed the cash flow test. With a cash flow of $1,176 per year, it is what we call in the black. It failed year 1 cash-on-cash return, only bringing in 3.4%. In order to pass this test and achieve 8%, we would only need to increase the rent or lower our monthly expenses by $140 per month. Considering we built in 5% cushion into our expenses, this is very achievable. So, although it failed year 1, there is enough cash flow potential to keep this property on the table. It passed both rent to value and cap rate, meaning this property can be added to the green list of potential investments. The 25-10-in-1 rule states that you do this quick analysis on 25 properties. The 10 properties with the best fundamentals make up your green list. Once you have built your green list, you can conduct a long analysis on each of the 10 winning properties to calculate their projected return. For calculating overall return, I highly recommend going to BiggerPockets.com, making a free account, and using their investment calculators. I'll throw the link in the description. And that's pretty much it. Once the math reveals which property is the best performing, you have found your golden goose. Now you can go put in an offer and try to lock it down. Keep in mind, all of the properties you see on Zillow have already been viewed, weighed, and measured by other investors, so anything worthwhile is going to fly off the shelf fast. This is where a realtor can come in and show you off-market properties with more complete data before the competition gets to them. I really hope that this video has given you the skills and confidence you need to optimize your earnings and start pursuing financial freedom in real estate. Happy hunting. A couple of notes. Not everyone lives in a cash flow market. Many markets in the United States, like San Francisco and New York City, are more suited for appreciation investing. So don't be disappointed if you've plugged away at 20 properties and none of the cash flow metrics have penciled out. If you'd like to invest for cash flow but you live in an appreciation market, consider out-of-state investing, house hacking strategies, or short-term rental opportunities like Airbnb. For more information, check out Finzilla's recommended studies linked in the description below. For out-of-state investing, we recommend Long-Distance Real Estate Investing by David Green. For more investing fundamentals, I recommend the Hold Workbook by Steve Chater. For podcasts on real estate investing, check out BiggerPockets podcasts and our good friend Robert Leonard's podcast, Millennial Investing. Finzilla. Devour opportunities. If you like this video and want more, you know what to do. Let me know in the comments what topic you want me to do next. Thanks for watching.